Did you listen to me in mid-February when I rated Microsoft as a buy? Get an implied share price of $546 compared to the current close of $411. That's nearly a 33% discount, which is a screaming buy rating. Well, since that recommendation, Microsoft has crushed the market by 2.5x. Don't worry if you missed out, because today, in under 20 minutes, I will provide what you need to know if you want to invest in Microsoft. Trading near 510 per share, I have a buy rating on Microsoft stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the fiscal year 2025 results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Microsoft, and my conclusion on Microsoft's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with Microsoft. If you're enjoying this, please smash that like button. Microsoft beat Wall Street revenue and EPS estimates, and they presented investors with exciting nuggets that I'm about to cover in detail.
Any news?
Let's cover the red flags first. Microsoft has already locked in huge data center obligations. You can't just slam the brakes. Planned capex of $30 billion next quarter is a massive amount. If AI demand cools, those commitments can still pressure cash and short-term margins.
So that's the goal for us, is to be able to really, at the end of the day, make these long-term capital investments because of the attractiveness of the market and the policy stability.
Data centers need land, power, and water. Shortages or outages will hit performance. Green energy transitions and environmental rules can add costs and delays. There are only a few suppliers to critical AI parts. Any hiccup can slow builds and raise costs. Everyone's chasing the same GPUs. Export controls or shortages can bite.
This will be 10 times more powerful when it opens in early 26 than any existing supercomputer on planet Earth. And that's because of the sophistication of everything from the engineering design, the partnership with NVIDIA, even things like liquid cooling, so that you can run infrastructure at this scale.
New and evolving AI laws increase costs and force production changes. Wrong and biased results from ChatGPT can harm reputation. Non-compliance risks fines, constraints, and slower rollouts in key markets. AI's energy needs are very high, and activists warn that the public could end up footing grid costs. Short-term fixes like off-grid gas turbines raise costs and create policy risks for UK projects.
I give huge credit to the White House, to President Trump, and to Prime Minister Starmer, for putting in place the kind of regulatory stability that will ensure we can invest in the UK and the customers in the UK can trust, as they always have, our technology from Microsoft, from the United States, knowing that they have a reliable source of supply.
Microsoft raised Xbox prices twice in 6 months in the US. Tariff costs are biting hard. Higher console prices risk softer demand in a consumer-sensitive category.
Well, of course, our little tariff agreement.
Here's what got me really excited. Azure revenue topped $75 billion, up 34%. AI demand is already showing up in the numbers across workloads. Copilot now tops 100 million monthly active users, and paid seats just had their biggest quarter. That's broad, sticky usage. Monetization is scaling quickly. The backlog is $375 billion, and approximately 41% turns into revenue within a year. A huge chunk of next year's sales are already lined up.
We keep spending, but every dollar we spend is based on a very sophisticated calculation. We're spending to meet demand and to meet the demand we see growing.
The Microsoft 365 base keeps growing. 89 million consumer subs, commercial cloud up 15%. That's a massive built-in channel to push AI features like Copilot. Fabric revenue is up 55% year over year with over 25,000 customers, the fastest growing database product in Microsoft's history. The data layer that feeds AI is scaling quickly. This is what everyone is missing. Microsoft pledged $30 billion to UK AI infrastructure, its biggest investment outside of the US. Multi-year capacity build in a key market signals durable global demand. And Microsoft is diversifying beyond the US to dominate AI globally, not just at home.
As you just heard, the tech behemoth, the world's second most valuable company, says it plans to invest $30 billion into UK artificial intelligence infrastructure by 2028, betting big on Britain's technological future as part of a US-UK tech agreement, which includes the likes of Google, Nvidia and OpenAI. The Prime Minister, Sir Keir Starmer, has called the deal a generational step change in our relationship with the US. Speaking exclusively to the BBC, Microsoft's chief executive says AI could boost the UK economy by 10% in 5 years.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
No.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Microsoft has over $30 billion of cash, and if we combine with cash invested in securities, it's almost $95 billion. This gives the company a stockpile of cash to invest in the future, whether it is AI data centers or their rapidly growing cloud business, Azure. PP&E increased over 51% since last year, and it's projected to more than double in 5 years by the end of the model. The bulk of the capital expenditures growing the PP&E is due to the multiple AI data centers that Microsoft is building worldwide. Debt decreased by $8.5 billion to $43 billion. Despite massive capex spend, Microsoft is still net cash, which means cash is greater than debt by almost $51 billion. This means that they can completely pay off their debt and still have $51 billion left over. So what's the takeaway? Microsoft has a massive amount of cash, its debt is declining, and it has a AAA credit rating, which is better than the US government. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Microsoft generated a massive $282 billion in revenue, with 66% coming from server, cloud, and Microsoft 365. Top-line revenue grew 14.9% in 2024 and is anticipated to continue growing in the low to mid-teens over the next 5 years. Gross margin has been solid and steady over the last 5 years, while EBITDA, operating, and net margins have all been expanding since 2023. This shows incredible cost control and operating efficiency despite growing rapidly. While revenue grew 97% over the last 5 years, net income grew a staggering 230%. Remember, revenue is what you make, net income is what you keep. So Microsoft is flexing its operating efficiency muscles. So what's the takeaway? 15% revenue growth, incredible cost efficiency, and growing net income means money for shareholders, which we love to see. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. Operating cash flow increased over $17 billion in the last year, primarily driven by the strong net income that Microsoft is generating. Like we have seen before with Microsoft, maturities and sales of investments over the last 5 years was nearly $220 billion. This is the money that Microsoft is making from its invested cash, but that isn't even the craziest part. Share repurchases and dividends over the last 5 years was $218 billion. So Microsoft is using returns on its cash to pay dividends and buy back shares without impacting the business. While we see $29.6 billion of debt issuance last year, nearly all of it was paid off in the same year. The bulk of this debt was used in the $74.5 billion buyout of Activision Blizzard, which was completed in October of 2023. This deal has rapidly and significantly increased gaming revenue over the last 2 years, and it will continue in the future. So what's the takeaway? Microsoft is using the returns generated from its cash to reward shareholders, and it has money left over to invest in AI data centers and continued growth in its cloud business. So what does this all mean for the valuation of Microsoft stock? Let's cover that next. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $4.6 trillion. We divide by the current shares outstanding. We get an intrinsic value of $621. Compared to the current close of $509, that's a 22% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my thoughts on how to play Microsoft stock later in the video. So what does Wall Street have to say about Microsoft stock? Let's cover that next. Wall Street is generally bullish on Microsoft as it starts to show real evidence of AI positively impacting its business and future. Barclays maintained an overweight rating with a price target of $625. Barclays is keeping Microsoft as a core AI and cloud beneficiary. RBC has a buy rating on Microsoft and they raised their price target to $640 from $525. RBC highlighted Microsoft's leading AI and cloud positioning and durable long-term software advantages. Truist has a buy rating on Microsoft and they raised their price target to $675 from $650. Truist cited confidence that Microsoft can sustain momentum from AI and cloud secular growth drivers across Azure, data, and app layers. CapIQ gives me a sense of how other analysts on Wall Street view the company. 50 analysts cover Microsoft on Wall Street, which is a ton. The target price ranges from a low of 483, which is a 5% decrease, to a high of 700, which is a 37% increase. Upside outweighs downside by 7.4x. Hedge funds typically look for 2 times and greater. The median is 630, which is a 24% increase. The overall rating on a scale of 1 to 5 is 1.26, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I'm a huge believer in Microsoft, and it's the second largest position in my portfolio at a weight of 11.2%. If you decide to buy Microsoft, you need the right entry point, which I'll reveal shortly. Microsoft sits on about $95 billion of cash and cash equivalents. They can fund AI expansion and ride out bumps without scrambling for cash. In 2019, Microsoft invested $1 billion in OpenAI, starting their exclusive partnership. In 2023, Microsoft extended the partnership, investing an additional $10 billion. The most recent valuation of OpenAI was $500 billion. Microsoft has a 49% share of the for-profit OpenAI Global LLC. Not only is Microsoft getting a nice return on investment, this investment solidifies their leadership in the AI arms race.
We're excited about the framework that was announced last week. It is the foundation for the next chapter in what I think is an extraordinary business partnership between OpenAI and Microsoft. And let's face it, neither of us would have gained the level of success without the other. And I think it's very exciting to now see what OpenAI's transition will mean to a kind of for-profit enterprise. Big benefit for the nonprofit with all of the right legal considerations in mind.
The Fairwater Data Center, opening in early 2026, will be the most powerful AI data center on Earth. This first mover advantage will be incredibly tough for others to compete with.
When this opens early next year, this will be the most powerful AI data center in the world. And there's a lot of things that go into that. It has the most advanced NVIDIA GPUs. It has more GPUs under one roof than any building on planet Earth. More than 100,000, literally hundreds of thousands of GPUs, all knitted together into a singular infrastructure and architecture in terms of networking systems, storage, and the like.
Microsoft hit a 52-week high of 555 at the end of July, and it's down over 8% since then. Despite delivering incredible financial results, the stock is traded down, which presents a window of opportunity for smart investors to grab Microsoft at a nice discount. My model shows a value of $621, which is a 22% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Microsoft is a buy at current levels. If you're looking to buy Microsoft, I would want to get in at $517.50 and below. For a AAA rated company with a dominant position in the AI cloud and operating systems verticals, Microsoft will be the big winner in the AI race. Their financials are already showing the positive impact of AI integration. Microsoft stock is presenting investors with with an incredible buying opportunity in a company with rock-solid financials that will help you sleep easy at night, knowing that you have the best AI company in your portfolio. If you like this and want to see another in-depth stock valuation, check out my SoundHound video here or my Lululemon video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.